Well, I agree with him. We're in a period where there is a super cycle and exponential growth opportunities within AI. But it doesn't mean every company that has elevated valuation today deserves to actually have the capital, and that company may not even reinvest that capital properly to be a survivor. So I agree there is going to eventually be a shakeout, but I think valuations, strangely enough, are actually pretty reasonable today compared to 1998, because 1998 was that liftoff point before that final 18-month surge. And I'd say the best benchmark is NVIDIA trades at 26 times forward earnings. Cisco at that same exact moment was at 60 times, and Cisco's PE peaked at 210 times forward earnings. So NVIDIA to me is still a bargain at 26 times. It's cheaper than Costco and Walmart, which are close to 50 times forward earnings.
Sure, but all valuation isn't created equal. And I'm not especially clear as to whether Mr. Griffin looks at the valuations of an NVIDIA, for example, and says, well, that looks a little out of hand. It reminds me of late 90s activity before the dot-com bust happened, parabolic. And they're related to AI. And that's where he says, whoa, 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 whoa. We're placing way too many bets on what might happen in the future. We think we know what's going to happen in the future as it relates to NVIDIA and some of the other hyperscalers, but it's a whole host of other names that have literally ripped over the last 3 months, at least, that might bring investors a little bit of pause.
I think that's correct, Scott. There's a difference between a company being scarce in the public market. Like, let's say there's an IPO of a company and it's the only way for you to get exposure, versus that company being truly scarce to the ecosystem. So I do think investors have to discern, is this company going up a lot because this is the only name out of a possible bevy of private companies, or is this the company truly unique and one that is so scarce I got to give it the N=1 valuation?
I mean, I think he looks also at a stat like JP Morgan Asset Management's Michael Sembalist brought to us today from his report. And he's good at what he does, okay? Quote, AI-related stocks have accounted for 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending growth since ChatGPT launched in November of 2022. Now, some would say, well, obviously, and all of that might be justified, but those are large numbers. Those are really large numbers that have carried a boatload of the weight of this move in the market since then.
Yeah, and that's a moment in time, Scott. I mean, just to give some perspective, NVIDIA is about 8% of the S&P 500 market cap weight, but it is also 7% of the earnings. So it's not necessarily distorting equity valuations. And in terms of what companies are excited about, if companies are saying that AI is something where they're actually allocating capital, and many are, of course, are seeing productive gains, I think it's justified that would be what you'd expect to be the first wave of investment and spending, is around directly into the ecosystem. But of course, over time, we'd expect that spending then to deliver productivity gains and other benefits. So that means if AI, and I'm comfortable with the idea it's a super cycle, we should see a broadening of the benefits and then also the broadening of opportunities over time. So it's probably a moment in time makes sense, but it should be broadening.